very intrigued with the fact that John Williams was instated at the New York Fed, and that from everything that I've heard and I understand, Powell was 100% in support of the Williams move from the San Francisco Fed to the New York Fed, even though the New York Fed is the presidency of the New York Fed is the most second powerful position in the entire reserve system, right? If Jay Powell gets the flu, who is the vice chair of the Federal Open Market Committee? And that is the presidency of the New York Fed. So few people understand how important it is that a pure academic has just been placed in charge of supervising our nation's financial system. This is somebody who has said in public, I don't have a Bloomberg on my desk. He's charged with tracking the financial markets and financial stability. So it's very intriguing to me what is happening today, the disconnect between what the administration is doing and what the Federal Reserve is doing internally.
Now, the Federal Reserve, what do you think, in your opinion and analysis, is their realistic exit strategy for interest rates and the other emergency measures that have been put in place over the last 9 years? We know what they say publicly, but I think even anybody who understands basic arithmetic would understand that you can't really raise interest rates past 3%, 4%. You'll blow the economy up. So what is their realistic exit plan, in your opinion?
Well, I think that they're hoping against hope that the markets withstand the tightening path such that they at least get to 2.5%, 3% on the Fed funds rate. But clearly the bond market is in complete disagreement with the Fed's hopes and aspirations. Again, this is a $21 trillion global experiment in quantitative easing. And I think it's highly naive for anyone to think that extrication, that exit's going to be friendly.
Okay, so let's say we have, severe volatility or even something close to a Lehman Brothers crisis. Could the Federal Reserve and policymakers even deal with that at this point? Because they've spread themselves thin, and they're still essentially at crisis levels when you consider where we are versus the economy. So what could they do during the next recession?
It's interesting, Tasha, because somebody tweeted out a question to ask me after you, in any event. It's interesting because this particular lower for longer period has created nearly 250. Well, we're almost at $250 a trillion in the global credit markets, right? They dwarf the size of the stock market, but it's not in the same place right now. It hasn't all occurred in the banking system. It's not the bulge bracket huge financials that are exposed. This time around, it was the capital markets that opened up for business and prevented companies that should have gone bankrupt and restructured. That prevention occurred, and so, but it's been the bond markets themselves. And I don't know how much control that central banks could exert over publicly traded markets. It's one thing to come into the banks and hold a gun to the head of the largest CEOs of the banks and say, we will clean up this mess. But because of Dodd-Frank, we don't have the same backstops that we once had for the capital markets. And therefore, I don't know that the Fed has even as much control as it had in 2008 and 2009 to stem the damage.
Okay, so first off, for the listeners who are just hearing about you or haven't seen any of your other interviews or haven't read your book, Fed Up, which I highly recommend. Again, you can also see your commentary at Money Strong, and we'll have all the links and URLs up to either purchase her book or check out her commentary at her website. Talking to Danielle DiMartino Booth. Danielle, by the way, my name says Tasha because that's my assistant's name on Zoom. So for the audience who would call me Tasha, my name's Daniel.
Daniel
and Danielle, this is gonna be easy for us. So
we're the Dan and Dan show.
Yeah, Danielle. Do you, as a, first of all, what was your role in the Federal Reserve prior to essentially, I guess, retiring or quitting and starting Money Strong?
Well, so I was the advisor. I was an advisor to Richard Fisher on monetary policy. And in the Queen's English, that just means that I monitored every aspect of the financial markets on his behalf. And before he would go off to every FOMC meeting, I would brief him on where I felt the markets were, whether you're talking about private equity, the public markets, commercial real estate, the full gamut. So I followed Richard Fisher in, and I did not fit in among the bureaucrats, let me tell you. Mm-hmm. So the minute he retired, I followed him right back out of the Fed. And what I do at Money Strong is essentially the same thing that I did for Richard Fisher, but I do it for the public. And that is that I monitor the financial markets and I look for signposts that suggest inflection points are upon us. Clearly 2017, the only signpost was complacency. And in 2018, we have all kinds of different signals that we're getting on a daily basis. So we've literally gone from being in a comatose state to being somewhat manic in the space of a few months.
What signposts are you seeing right now?
Well, what I'm following the most closely is actually the 2-year Treasury note. Yields on that 2-year keep ticking up. And I'm looking for signs of yield curve inversion, but more than that, it's fascinating to me to follow what's happened with LIBOR, right? The shortest term rates out there, and to see the Fed effectively chasing LIBOR upwards. It's as if the tail is wagging the dog. But I'm watching that 2-year Treasury. We're at 46 basis points. We're at a 10.5-year low on the difference between short and long rates. And that is about as clear of a signal as you can possibly get, again, in a world where central banks have been buying up so many securities that it's very difficult to try and find signals in that kind of an environment.
Yeah, so everything's been distorted. And, so do you keep in touch with anybody there? Do you feel that they're also focused on the same things you're looking at right now? And are they responding in such a way that could actually be helpful?
Well, I do actually think that policymakers right now are paying attention to the yield curve. Jay Powell mentioned it in his first press conference, which lasted all of 43 minutes, because he's not messing around. He's not talking models. He's not using jargon. He's not trying to intentionally confuse anybody. But he said he was paying attention to the yield curve. And I believe him. He's a man who comes from a background in banking and finance and private equity. He understands what all these things mean. And he'll also be a wise enough soul to follow what companies are saying. He started the industrials group at the Carlyle. So he speaks to CEOs all the time, and I'm sure he's hearing anecdotes about how their input costs are going through the roof and how difficult it is increasingly to source skilled labor. That translates into wage inflation, regardless of what the core PCE may or may not be saying. I think Powell's much more of a pragmatist, and I think that he is paying attention to a lot of what's going on in the markets. That's his language.
When you were at the Fed, or do you believe the Fed from your observations, do they pay any attention to the gold price when it comes to inflation, or do they really only focus on these completely distorted CPI numbers that they've created?
Well, when I was on the inside, there was certainly a solitary focus on a broken metric. The problem with gold, though, is that in inflationary and in deflationary times, it has outperformed. So it's not a pure reflection that I think a lot of people tell themselves that it is. Mm-hmm. What it is, however, especially in a world of quantitative easing and central bank-led distortions in market, what gold is, however, is the one place to hide when correlations line up between every other asset class. So it is the ultimate safe haven. So I would suspect that any savvy central banker would certainly pay attention to that, because it is a signal to them that potentially central banks are losing control.
Do central banks see gold as money or a monetary competitor?
I think that the central banks are going to follow electronic currencies as a matter of national security, but they don't think of gold the way gold bugs think of gold at all.
Okay. And then on the inflation front, are we going to see severe price inflation over the coming years? I mean, you've got tax cuts, you've got the economy seems to be, stimulated from every source, whether it's the federal government, the deficit spending, which could also be deflationary at some point, but also what the Fed's doing. I mean, are we going to see inflation that a lot of people have forecasted?
I think we are going to see inflation over the medium term. There was something very remarkable that came out in the most recent release of the Fed minutes. And that is that not a single member of the FOMC saw downside risks to inflation. That is the first time that that's happened since record keeping began in 2011. So what that is telling you is that there is universal consensus on the FOMC that there are upside risks to inflation. My greatest fear is that we end up with a stagflationary environment, which would be the worst of all worlds, where we got slow growth and rising prices at the same time, because nothing squeezes households tighter and nothing is uglier for an economy than stagflation. But to reference my good friend Lacey Hunt, because we have continued to build up debt in the background, that means that by definition, we have deflationary forces working against inflationary sources because you have to service the debt. And every single penny that you have to allocate to interest expense is taken away from money that you would spend in other places. So generating inflation is truly a conundrum. I believe it's real after the year of natural disasters that 2017 was. It's not a figment of my imagination that lumber is within a hair of its all-time high since back to 1986. It's over $500. These input costs are truly inflationary. They're truly hurting companies. But again, we have all of this debt that we've created trying to solve the problem to service. And it requires more and more money the more interest rates tick up.
Sure. And now we're going to have an annual deficit of over $1 trillion. So in your opinion, where is this all heading? Where, the US government is going to have $1 trillion deficits. We're still at these artificially low interest rates. But at some point in time, the party's got to stop. This can't just continue. I mean, everybody, no one can defy math. So where is this all heading?
Well, it's interesting you say no one can defy math, because I think a lot of Keynesian economists will tell you that they can outlaw the rules of nature themselves, and that all of the world's debtor nations can come to a gentleman's agreement to monetize the debt across the board, and that this is the ultimate way out. When I hear those things, it scares the heck out of me. And the only thing I would say to the Keynesians, and the idea that the rules of math can be rescinded permanently, and we can just monetize the debt away. Forget about inflation. We can just make it go away. The only thing I would say is that the inequality issue globally, and I'm not conflating issues here at all, I promise, but that the inequality issue globally is such that when you manipulate things to too great of an extent against a backdrop of record inequality, you're playing with fire. And the risk is that a de facto currency war turns into an actual hot war. All hot wars begin based on some kind of economic misalignment that affects increasingly higher numbers of people. And that's where we are today.
Do you think Chairman Powell and the President of the United States and his inner circle of economic advisors, do you think they understand the scale and size of the situation that's in front of them?
I hope that is the case. All they have to look back on to guide them is history. And that was $70 trillion of debt ago. So worst case scenario that our leaders have to go by is debt that was about 150 trillion back in 2007. But since then, we've tacked on an additional $70 trillion of debt and counting. So I don't know that any leader, I don't know that any market watcher, I personally certainly cannot say what should guide leaders in a world that is truly, it is different this time. And I hate that cliche more than any other out there, but mathematically it is different. Because the difference between 150 trillion and 240 trillion dollars of debt is material, and it is going to present policymakers, politicians, central bankers, parties, pension funds. It's going to present all of these parties with the greatest challenge in our lifetimes.
Okay, you've looked at this problem extensively. You've written about it on your website, and you consult with individuals and companies, as well as have written a book, Fed Up. I'm going to close us out with 3 questions, but they're the same question. What if you had the chance, what do you tell Powell? If you had the chance, what do you tell Trump? And you do have the chance, what do you tell the listeners today? What can they do for as an individual? You can answer that in any order you'd like.
So I would tell Powell and Trump the same thing, and that would be to get along with one another and not to force Powell to take interest rates to the zero bound again. To use 2% as a new floor, because the distortions introduced because of zero interest rate policy far outweigh the benefits in the long term. So I would implore upon President Trump to not pressure Powell to lower interest rates when the peanut butter hits the fan. As far as what your listeners should be listening to the fact that some of the savviest, most weathered market veterans are sitting on record piles of cash today. And I think that actions always speak louder than words. Mm-hmm. So having a safe haven, despite the fact that, if you turn on Bubble Vision, they'll tell you that the market disruption of February is a thing of the past and that it's just straight up from here and that earnings are wonderful. And then they sing you a stanza of Kumbaya. Leave your CNBC on mute. With all due deference to CNBC, I have quite a few good friends there, and I'm on all the time. Follow the actions, not the words. Money managers are sitting on record levels of cash. That tells you that they're worried.
That's a great point.